Yes. We'll go ahead and get going. We do have quorum now. Okay, everyone have their agendas. We'll call this meeting to order at 3:01. I don't think we have anybody from the public. Anybody receive on the board any communications? I have not received any. If not, Cindy, do you have a finance director report?
I do have a report. Oh, boy.
You get a report, you gotta be on there.
Okay, well, I'm down in the corner a little bitty. That's good. Good evening, everyone. I hope that you all have received my March 31st report. You will see that we had, fortunately, we had increases to dividends and we had a gain this year. As on the expenditure side, because this is the third quarter of the year, we're rapidly looking at the end of the fiscal year, believe it or not. So the expenditures are as they should be, except for SEI. We've only posted through December. We have not posted the first quarter of that yet, but Sageview is through March. And the increase to return of contributions, we did have 5 employees that left the town and have taken their money out of the pension fund. So I think that you just have my reconciliation at the bottom, and I'll answer any questions, hopefully, if you have any. I guess not.
Okay.
We'll turn it back over. I hope you can hear me.
I'm sure they can. Okay, moving on to the approval of the minutes. Hopefully the board has the February 11th, 21 meeting minutes. Whenever you're ready, I'll entertain a motion.
So moved. This is Mark.
We have a first. Do we have a second?
I'll second it, Jason.
Okay, we have a motion and a second. Is there any discussion? Any changes? If not, all in favor, say aye.
Aye.
Aye. Okay.
Hey, John, just,
Yep.
maybe do we have a quorum?
Yes, it only takes 3 for these. We have 5 existing members, 3 are here. You guys Lori looked at that, right?
Mhm.
Yeah, so the finance department double checked that before the meeting. Lori did.
Okay.
Moving on to number 4, authorization of payments from retirement fund for retirement benefits. We have several of them. Usually we do these as one motion.
Hey, John, just a question. Out of all these, you've got 3 from the police department. Is there anything going on in the police department that,
No.
any incentives that have been provided
No.
or?
No, just Chief Pissarro just says it's that, just timed out that way.
I hate to tell you, I remember when some of these folks joined the force.
Let's see. Then we have a
Clearly, we got in
motion.
the wrong profession.
Yeah. Government's the wrong profession nowadays.
I'll move all of them as presented.
Okay, I'll second it this time. Is there any discussion? If not, all in favor, say aye.
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 Opposed, same sign. Okay, moving on to SCA. Pat, you're up.
Okay, would you like me to share my screen?
Yeah, let me see. Let me make you co-host here. Okay, now you should be able to share your screen.
Okay, great. Okay, let's put it in slideshow mode here just to make it a little bit bigger.
Hey,
Okay,
Pat, as you go, can you
everyone's
give?
doing well?
Hey,
Hopefully
Pat,
most
before you
people
start,
are vaccinated
as
by
you go,
now.
can you give page numbers so people can follow along?
Yes, I will. So I'll be starting on page 3, just the
Okay.
executive summary. You can use some of this for the minutes, and I'll go through all these bullet points as I go through the presentation. But why don't we get right into it on slide 5. So the market performance overview. So last meeting we discussed, we started to see a transition from those big names, big growth names into more value, cyclical type oriented companies towards the end of the fourth quarter of last year. And we continue to see that theme through this year with a little bit of choppiness. But all in all, we've had very strong returns. Because we had a downturn yesterday, some of the indexes fell below their records, but the Dow was at a record at one point, the S&P 500. The NASDAQ has been one of the indexes that has been hit as a result of that transition more towards these names, which I'll be discussing in more detail in the next slide. But all in all, we're seeing very strong returns on the US side of the equation, good returns in developed international, emerging markets. On a one-year basis, you could see small cap has tremendous returns. So it's tremendous comeback for the hardest hit asset class during the pandemic. And on the fixed income side, we'll talk more, but we've seen rates rising. So on a one-year basis, investment grade bonds are actually flat now. But when you look at it from just the first quarter's perspective, they're actually negative. Long duration bonds, even more negative, and high yield bonds held up very well for the most part. Emerging market debt took a hit. A lot of that has to do with the dollar, as well as some of the things we're seeing right now with just the COVID spread in India, Brazil, and other emerging market areas really have taken a hit. Unfortunately, it's very sad, and hopefully we can help them get that under control. Commodities have done very well as a whole. I would say for the most part, you're seeing metals and oil driving the commodity prices higher. We haven't seen that in quite some time. Commodities have been one of the laggers, and not only in this portfolio, but as a whole relative to other asset classes. So I wanted to bring this chart back. We looked at this in January. We looked at it as of the end of last year, and it's a much different story that we're seeing here. So when I looked at that chart from last meeting book, we saw the big five names up over 35%, right? Then we saw the rest of the S&P 500, which is the S&P 500 minus those five names, just around negative 2% or 2%. So there was a huge deviation last year. We saw the big growth names, stay-at-home stock names do very well, which led the S&P 500 higher. Whole slew of names have been left behind in this rally. We're starting to see them outperform. So when you look at the chart now, you can see the rest of the S&P 500 is actually leading the way. So it's up 7.48% through the end of March, where we're seeing those big five names just around 2%. So quite a bit of a difference. And you can see that we started to see that transition that kind of we've been waiting for a long period of time here. Any questions around that chart? Okay. You can see it here as well. So if you look at page 7, a couple of charts. Top right-hand chart, we're seeing the US small caps outpace the large caps. Again, that's another thing that has not happened in a while. And a lot of that has to do with the light at the end of the tunnel, right? We have 3 vaccines out there in the marketplace right now. About 35% of the US is fully vaccinated, and there's a lot that have their first shot. We need to get that number up, obviously, but it's come a lot quicker than people thought. It's been happening a lot quicker. It started out very rough, but we've seen things smooth out, and people are getting shots in the arm. So that's really helped these small cap companies. They're the ones that struggled. They're the ones that have been shut down for a long period of time as a result of the pandemic. Now the value and growth story plays out again, bottom left-hand, far left-hand corner. You can see value has outpaced growth for the quarter. So you can see the first quarter, about 11.7% versus just about 1% there for growth stocks. So all in all, we've seen that trend. There's also been a change in leadership. So last several meetings, I've showed you this chart. You saw technology on the front end. You saw consumer discretionaries on the front end and areas like that. So now we're seeing energy, financials, industrials, materials kind of lead the way for the quarter. So you're starting to see that transition into those areas. And for the most part, they're more value-oriented areas. Some have been driven down just by prices, and they look better from a valuation standpoint, but other areas have always been strong value, cyclical areas that have just underperformed for several years, and we're starting to see that transition. International front, I touched on this briefly. The US still kind of led the way for the first quarter, but there's some bright spots. We saw some pretty solid performance in emerging market areas. Obviously, Latin America has been hit. They've been really hit by the pandemic, but we've seen some positive areas on a quarter-to-date basis in developed international and areas of emerging markets, Pacific, Asia, things of that nature. Japan was relatively flat. So, but all in all, when you look at the one-year trailing number, we got pretty strong performance across all these asset classes. Again, with US leading the way, but still from a diversification standpoint, those asset classes help not only diversify, but give you more absolute return in the portfolio. So I want to stop here because this is where I'm going to focus the most, and I'm going to talk about a couple of things that are going on now. I used to speed right by this slide because the 10-year yield really was range bound for about 5 years to 8 years. Now it's much more important because there's a lot of things that are creeping up that we're hearing more and more about. And one of those is what's going to happen with the potential for tax rate increases. The other one is we're hearing a lot more about inflation in the market. That's coming out more and more. So those are the two primary areas. And then also, obviously, the infrastructure bill, they're actually speaking right now about that. The infrastructure bill is out there, and it's proposed somewhere between $550 billion and $2 trillion. So I'm sure if it comes through, we'll probably land somewhere in between there. But that will be good for the economy as a whole in the long run. It takes a while to get return on capital from infrastructure deals. First of all, you have to build it, then it has to be up and running, and it takes a while for that income to come back. So from a tax standpoint, individual income tax rates could go from 37 to 39.6. Okay, so that's basically ordinary income tax rates. That's typically will be for households of $1 million or more in annual income. Then we have a corporate tax rate. That could change, but right now it's set to go from 21 to 28. So kind of pre-Trump era levels. In some cases, a little bit lower than that, but as a whole, that could happen as well. And then, so that's pretty much it. And long-term cap gains from 20 to 39.6. And that's big, right? Because if you think about, and that's also hurt some of these technology stocks, because once that news came out and you had these household names, big tech names, you had tremendous gains build up in those in your portfolio, tremendous gains. So we started to see some sell-offs in those areas to get in front of a potential cap gain tax rate hike. So that's happened as well. So a lot going on. Inflation, all in all, the Fed wants to have kind of a medium-term 2% target for inflation. We've seen the recent quarters exceed that. So we've seen recent quarters go as high as 4.5%. They're aware of that. They know there's going to be times where it spikes up 4.5. But again, they're looking at the longer-term trend for inflation. And this year, they believe it's going to be about 2.1% when you average the whole year out. And by 2023, this year, inflation about 2.4%. And by 2023, 2.1%. So we are going to have spikes, but all in all, they believe inflation will remain subdued. That's to be seen. I mean, we have areas of the portfolio where we have some protection around inflation, areas like high yield, areas like REITs, things like that do offer some protection in an inflationary environment within the portfolio. And then in the fixed income side, we've positioned for some of this already. We have Treasury inflation protection securities in our portfolios. They tend to do well in inflationary environments. So again, we're keeping an eye on this from a management perspective, looking at our managers and positioning our portfolios. But we don't see this as an immediate threat, but it is absolutely on our radar. Okay, so that was a long-winded talk about inflation. Yields are right now, the 10 years about 1.66%. I think last time we met in January, right around 1.5%. You go back to August of last year, they're around 0.5%. So we saw a pretty good spike in the 10-year and across the yield curve, quite frankly. Well, 7-year and out, shorter end remains pegged at 0 because that's the Fed funds rate.
Hey, Pat, Ken, I think it's important just to remember, with inflation generally will come higher rates as the Fed fights to beat inflation. higher rates, can't hurt the equity markets, but they certainly help the liability side of a defined benefit plan. So we've all been waiting for rates to rise at some point to help on that liability side. This may be the time. The question ultimately is what's the balance between those rising rates and the impact on the assets, but also the impact on the liability. So it's possible that the funding status could actually improve, as assets actually head a little bit south. So we'll continue to monitor that in terms of the balance and how that impacts on the asset allocation. In fact, Pat and I actually have been talking about looking at that asset allocation model and hopefully having something for you guys next, if not next quarter, then the following quarter, but certainly this year as well. Sorry, Pat.
That's a very, very valid point. You got to look at the liability side and the impacts of that as well. Okay, so the portfolio was up to 147. This is on page 12, 147,778,900. So we've come a long ways. You can look at the beginning portfolio value on a one-year basis. We've had $39 million in investment gains. $4 million went out in net cash flows for member payments, benefit payments. So all in all, that's a very positive cash flow, net positive situation for the plan. Page 13, we take a look at the returns here. So your fiscal year to date will be ending in just under 2 months. And we're up almost 19% on a fiscal year to date standpoint, 18.81% net of fees, and we've outpaced that blended index of 18.37. The big number here is your one-year number, 35.32% return. So we've come a long, long ways from March of last year when we had that tremendous downturn. And we saw a lot of negative numbers, and we've gotten that all back and then some. So we've come a long ways. We do have light at the end of the tunnel, and things are looking up as a whole. Long-term perspective, looking out over 10 years, 8.38% net of fees. So again, what I look at there is from a long-term perspective, has the portfolio been outpacing your actuarial assumption rate on a net of fees basis? And it absolutely has. So that's a very positive trend as well. I'm not going to spend a lot of time on the performance. You can look through it here. Really nothing out of the norm. I know Ken will get into this in more detail, so I'll let him speak to that. But indexed on the equity side mainly, so we're going to have index-like returns. And we really didn't have any significant underperformance anywhere in the portfolio. Most of it was outperformance or relatively flat. Just looking at it from a calendar year perspective. And even going back all the way to 2002, we've outpaced your current actuarial assumption rate. So that says a lot on a net of fees basis. Any questions about the markets, returns?
No, it's not. Thank you. Good presentation.
Thank you.
I expect that good news every time you come.
Hopefully I'll be coming out there again soon.
Okay, going on to,
John, can I share my screen now?
yeah, just give me 1 second. Okay, you should be set.
Okay, you guys see that? Section 1 market overview.
Yes.
Okay, great. So the one thing I'll caution, or one of the things I'll caution is that I do think that volatility is with us. I think we saw that this week, where markets really went crazy negatively with the thought of inflation and rising rates and and the potential for that. It's important to know that we don't get 35% annual, returns all the time, and we can go, negative. And that's why we, believe in the concept of diversification and getting us, into areas that really haven't necessarily performed as well in the short term, but we think have the potential for that. And one of the areas that I think we're looking at is the area of international equities, and again, this is a chart that shows when the international outperforms the U.S. stocks, and that would be the purple mountain charts, as
What
opposed.
page is that again? Oh, there, got it, 15.
I'm sorry, page 15. Yes. So it's again, purple represents when the international have outperformed domestic, and the gray represents when domestic have outperformed international. You can see all the way to the right, that basically the domestic have outperformed significantly over, a relatively long period of time, almost 10 years. Why can that change? Next page really looks at the potential earnings growth as we go into 2021 and beyond. And we believe that the Japan, Europe, the emerging markets actually represent opportunities for higher growth than the US and even China. And so when you have higher growth opportunities along with valuations that appear to be cheaper, on the international side than the US side, that's it's a great recipe for, putting money into the international markets. It's sort of like, believing that at some point in time rates will rise, and they are starting to, but you just don't know exactly when. So this would lend you the support that says, yeah, we're kind of geared up for a recovery in the international markets. Just don't know exactly when that will be, but I'm pretty sure that it will be at some point in time. So, we'll continue to look at that. And again, as Pat suggested on the fixed income side, we've seen a pretty good spike in longer term rates. Short term rates have really been relatively constant this year. And so where does that go? And that's the battle that the Fed will be fighting. I'm of the belief that as the pandemic winds down, knock on wood, hopefully, there's a lot of liquidity out there. There's a lot of pent up demand. A lot of people, people will want to get out and spend. And so I think there's opportunities for, a bust out in the economy. Ultimately, the question is how much of that is baked into the market already. Remember, the market, looks 6 months in advance. So I think the market is anticipating, that we will, be going through a kind of a bust out phase. The downside of that is, should something happen internationally, what's happening over in the Mideast, for example, if that blows up, if the pandemic, what's happening in India, spreads throughout the rest of the world, that could give us another jolt, maybe, as significant as we saw in the first quarter of last year. So again, I think the light at the end of the tunnel isn't the train coming at us. I think there's good opportunities. But I think we'll see some weeks like we're having this week where, we've got some significant volatility. And ultimately, I do think rates will be going up. And again, as I said, that is somewhat positive, at least on the liability side of the defined benefit plan. So we'll continue to monitor that as we go forward. Taking a look just, from the oversight perspective, as Pat said, the funds have done very well. We score it out under this last column, the SageView ranking, where we take a look at the criteria that's in the investment policy statement, and judge that against other comparable assets that you could be investing in these categories. As we score them out, if a fund gets a score of 50% or better meaning lower, that's a passing grade, and that's a good thing. So all of the funds that are in the lineup are in green, are all passing, and again, that's a good thing. And as we look at the average score, for all of the funds, the average score comes out to be a 12. Again, 1 would be the best. So you're almost in the top decile, when you're looking at the cumulative impact. So again, from a long-term perspective, as recently as a year, the performance of the assets have been great. We may get a little bit of a bump on a positive note if rates go up, to pull some of that liability down. Funding status may actually improve from what is already a pretty positive 80% funded status, as of last year. Any questions on that? So the last thing I wanted to get into was the projection or proposal to lower the expected return from 7.25% to 7%. We went to 7.25% back in the fiscal year 2018-2019. That was a drop from 7.5% previous to that. So we've been at 7.25%, for a few years now. One of the things that we do every year is take a look at the asset class expected returns, and for the assets that, for the asset classes that you're invested in. So what this chart looks at are those asset classes. So on the far left-hand side, you can see the asset classes: large cap, small cap, developed, international, emerging markets, core fixed, high yield, and REITs, real estate. And then the allocation that we're targeting for each of those asset classes. And so we then looked at, over a less than 10-year horizon, what would be the expected returns for those asset classes on a year-by-year basis. And in doing that, we look at a lot of industry surveys. We've taken a lot of information. We actually have a group that looks at it from a capital markets perspective as well. We come up with a 50th percentile, what an expected return for those asset classes are. So we look at it from a shorter term horizon and then a longer term horizon, which we believe is more appropriate for a long-term pension plan type of an expected return. So we focus more on the right-hand side, more than the 20-year time horizon. And you can see that for virtually all of the asset classes, with the exception of high yield, if we look at from 2018, 2019, all the way to the current, we've actually had a decrease in the expected return of these asset classes. And when you put those numbers into the model, what you're looking at, is going from an expected total return for the portfolio in the 7.25% range to what would be more, closer to 7%. In fact, it's even slightly lower than 7%. But, in terms of that confidence band, we think 7% would be realistic and reasonable, for that. So it's the drop in each of the asset classes, really dominated by, fixed income, where we went from an expected return of 4% in 2018, 2019, all the way down to 3.2%, as we go forward. So I think, having an expected return of 7% is reasonable. How does that kind of gauge and stack up against other public plans that are out there? Seems 7% is a number that a lot of plans are comfortable with. There are some that are higher than that, in the 7.1%, 7.25%, but there's a significant number that are lower than that as well. And ironically, what we did was we looked at, what's the expected return and what's the funded status of those public plans that we can get information on. And it seems the ones that are at 7% are actually, funded in a way that's comparable to what you guys are at about 80%, even a little bit higher, 85, 90% on a funded status. So, keeping that, in a way that's reasonable, allows you to make reasonable contributions to the plan, not over expecting, I think, we'll do well. So with that, I will see if there are any questions on that.
We were looking at, the net pension liability likely change with that 0.25%. We're thinking about 10 million, is that right?
Yeah.
Yeah, we're thinking about 10 million on the liability.
Yeah.
However, we did go to OPEB, we did change it to 7%. I am in favor of doing it for the pension too.
And again, it's an expected return. So, what the actual return will be, could differ from that. You're hoping that it will be higher. You get an actuarial gain, which is a positive thing. But I think, in terms of trying to budget and fund, I think 7% in this market, seems to make sense. Mark Foster, I know you work, with other, defined benefit plans as well. What are you seeing out there?
Yeah, no, I completely agree with you, Ken. I mean, when we're looking at funded status, 80 and above, we're starting to see everybody tick down into the 7, 6, 6.75, 6.5. Especially some of the de-risking that's going on within the marketplace. But there are those that are still up in the 7s. Their funded status tends to be in much worse shape. Therefore, they're taking more risk. But I completely agree that this would make a lot of sense at this particular time. And even though I think our overall estimates come in even a little lower than 7, I think this is a good first step.
Okay. Mark or Jason, your thoughts?
John, when you, I'm just curious, if all things being equal, we had a 7% rate of return for the current budget year, any sense of how much additional money the town would be obligated to set aside?
Cindy just stepped out. She's been looking at, she realized there's something missing from the pack. We'll come back to that in a second.
Okay.
John, I'm sorry.
Oh, go ahead.
I'm just curious as to, now, I'm totally in favor of changing from 7.25 down to 7%, but I'm just curious as to, is it a $100,000 additional contribution, or for the, I know things change going forward, but it would be for the current year if in fact we had done this previously.
Right.
Or is it a $300,000 or $400,000 or $500,000 delta?
This is Jason. I apologize. I'm having a little problem keeping up. I'm mobile, so it's going in and out. So I'm not the best person to kind of give feedback on this.
Yeah, I think whatever the impact is, I think we need to go to 7. Do you have a feel for what the increased cost would be with the 7? Cindy just
Mark,
returned.
I'm going back through the actual report that was delivered back in February, and there was a bullet point that a 25 basis point drop increases cost by about $450,000.
Okay,
So,
thank you.
What do you think? Are you comfortable with that?
You're going to 7%, yes.
Yeah, I think internally staff is all comfortable with 7%. So if at some point somebody wants to make the motion to change the, however it should be worded, but the pension plan expected rate of return on investment, changing it from 7.25% to 7.0% effective with the July 1st, 2021 valuation.
So moved.
And this is Jason. I'll second it.
Okay. Any discussion? All in favor, say aye.
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 Opposed, same sign. Okay. Done with that one. And then the next one under 7.1, Cindy realized that we were missing some information from the packet, the interest rate on employee contributions. Do you want to lead this discussion?
Sure. Hi, everybody. Sorry about that it was inadvertently left out of the packet. But once a year, we, the board, we do the calculation of what to apply to the employees' contributions as of June 30th of 2020. And it's based on a policy that was adopted by the retirement board in 1994. And that policy states that interest rate at 120% of the federal midterm rate would be applied, but there's a caveat that it would maybe never more than what the retirement fund earned in a fiscal year. So I've done that calculation, and for the rate would be 0.54% that would be applied to employee contributions as of June 30th of 2020. And we just need that the board make a motion to accept and file this information.
This is Mark. So moved.
And Jason will second.
Thank you.
We have a motion and a second. Any discussion? All in favor, say aye.
Aye.
I,
Opposed, same sign. Motion passes. Sorry for the whiplash of the video. I think we're all probably getting used to that too. Especially today, I'm on an iPad instead of a laptop. Is there any other business to come before us today? Anybody? Bob?
Hey, John, just, I know at some point we'll probably start meeting again
Yeah.
in person. Maybe it will be August, maybe not, but I just want to throw something out there just to consider. And this probably goes against what Pat would like, given his earlier comment, is whether or not we need to have our advisors in person at every meeting, and whether or not we could continue. Once again, I'm not looking to do it for every meeting.
Right.
I'm not sure I'm looking to do it at all, but I just think it's something we should consider. And if in fact that could relate or mean that there's some savings in terms of what we're paying our advisors.
Okay.
And just something I throw out there for you and Cindy to look
Yeah.
at if you're so inclined.
Yeah, we were kind of talking about that internally too. Yeah, we'll discuss that and put it on the next agenda.
Sure.
Okay, any other business? If not, I'll entertain a motion to adjourn.
So moved.
I'll second it, Jason.
Any discussion? All in favor,
I
say aye.
I,
Aye.
I apologize
passes.
again. I'm in and out of cell service here.
Oh, no problem. I'm just glad you're here for quorum. So,
Yeah, that's why I just made sure I stayed on.
Yeah, no, that's great. Appreciate it.
No problem. All right, have a great day. Bye
Bye,
bye.
everybody.
Thanks, everybody.
Take
care.
care.
Bye.
Take care.